Welcome to The Deep Dive, the show where we sift through the noise to bring you the signal, extracting the most vital insights from, well, often a mountain of information.
It's quite a mountain sometimes.
It is. Today, we're taking a deep dive into a powerful strategy that really speaks directly to a fundamental human desire. That quest for certainty, especially when it concerns our finances. It's really about generating predictable income in what feels like an increasingly unpredictable world.
That quest for certainty is definitely deeply ingrained. Consider Nobel Prize winner Daniel Kahneman's 1979 prospect theory studies. They just brilliantly illuminated how instinctively wired the human brain is to seek certainty over uncertainty.
Right. Especially with money on the line.
Exactly, particularly when facing potential financial losses. His research famously showed that a striking 84% of respondents chose a guaranteed $500 payout over a simple coin flip that offered either $1,000 or nothing.
Even though the expected return was the same?
Precisely the same expected return. It just reveals this profound bias. We often prefer certain, maybe smaller gains over potentially larger yet riskier ones.
And it's fascinating how this plays out in investing, isn't it? Instinctively, risk-averse investors tend to gravitate towards more consistent, stable returns.
It feels safer.
It does. But what's truly surprising, and where the kind of counterintuitive insight lies, is that this consistency, well, precisely because it avoids those large drawdowns and capitalizes on smaller, more frequent gains, it can paradoxically lead to higher compounded returns over time.
That compounding effect is powerful when you protect the downside.
It's a really powerful concept for anyone looking to build wealth securely and, frankly, with less anxiety. As the legendary George Foreman once put it, the question isn't at what age I want to retire, it's at what income.
Ah, that's a great quote. Perfectly captures it.
It really does. And that statement perfectly encapsulates the mission of our deep dive today.
Precisely. Our mission today is to explore how covered call strategies offer a compelling and, I'd say, fiscally conservative method for equity investors, particularly those focused on retirement income.
Yeah, that income focus is key.
Right, to achieve more stable returns, lower overall portfolio volatility, and crucially, a consistent income stream. This is really achieved through the systematic collection of option premiums.
So using those premiums strategically.
Exactly. Serving as a strategic means of reducing risk and providing, well, a modest layer of downside protection. This approach truly shines as a path to more predictable income.
Absolutely. And for those of you joining us on the Finbot Insights YouTube channel, get ready for a detailed exploration of covered calls and their practical application for achieving just that consistent income from your investments.
We'll get into the nuts and bolts.
We will. So to begin, let's just clarify the core concept. At its heart, what is a covered call strategy? We're talking about generating additional income from an investment portfolio and modestly offsetting a stock's downside exposure, right?
That's correct. It's an investment approach that I think ingeniously combines a traditional asset class, that's your equities, your stocks, with an alternative asset class, specifically call options.
Okay.
The core mechanic involves collecting an upfront premium in cash by selling, or as it's called, writing, a call option against an underlying stock that you already own.
So you have to own the stock first. That's the covered part.
That's the covered part, exactly. This is done at a predetermined strike price and with a specific contract expiration date. So by selling this call option, you're essentially granting the buyer the right to purchase your underlying stock at that specified strike price.
In exchange for?
In exchange for the premium you receive right away. And that upfront premium also provides, as you said, a modest buffer against potential market downturns. It kind of acts as your first line of defense.
So we're talking about layering something called an option on top of traditional stock ownership. Now that sounds intriguing and maybe a little complex to the uninitiated.
It can seem that way at first.
Yeah. So before we dive deeper into the strategy itself, could you maybe lay the groundwork for us? What exactly are options at their fundamental level?
Sure. An option is basically a contract. It grants its owner the right, but, and this is crucial, not the obligation.
Right, not forced to.
Not forced to. The right to either buy or sell a specific underlying asset at a specified price within a predetermined time period. Now, this underlying asset can be a stock, an index, an ETF.
Okay.
And options are termed derivatives. Why? Because their value is fundamentally derived from the price movement of that underlying asset. They don't really have inherent value on their own. Their value depends on something else.
Derived from the stock price, for example. Correct.
Exactly. And importantly, an option creates a legally binding contract between the buyer and the seller. That means there are clear rights and obligations for both parties involved.
That legal aspect is definitely crucial. Now, if their value is derived, how does that fundamentally change how we should maybe think about their risk profile compared to owning the underlying asset directly? And what practical benefits do they offer beyond just, buying or shorting stocks?
That's an excellent question. Because their value is derived, options can offer things like leverage, but also unique risk profiles. They aren't direct ownership, remember. They're contracts about potential future transactions.
Right.
So this expands your strategic toolkit in the market quite significantly. Firstly, and central to our discussion today, they allow you to generate income on existing stocks already held within your portfolio.
The covered call itself.
Precisely. Secondly, options can be used, perhaps surprisingly, to acquire a stock at a discount to its current market price.
Hmm.
Thirdly, they enable you to purchase the right to buy a stock at a certain price without actually committing to the full ownership costs of the shares themselves right now.
So controlling shares without owning them yet.
In a sense, yes. Lastly, options provide a means to protect individual stocks in your portfolio from large declines. That strategy is known as a protective put, or, on the flip side, to engage in more speculative directional bets on the broader market.
Okay, that offers a lot of flexibility beyond just traditional stock investing. Now, you mentioned call options in the definition of a covered call. Could you clarify the two main types, call options versus put options?
Certainly. A call option is a contract that gives its owner, that's the buyer of the call option, the right to buy shares of a specific stock at a stated price, which we call the strike price, by a certain expiration date.
So buyers want the price to go up.
Generally, yes. Investors who buy calls typically anticipate that the stock price will increase before the option period expires.
Yeah.
They're hoping to profit from that appreciation. They're essentially betting on the upside.
And a put option, then, is basically the inverse of that.
In essence, yes. A put option grants its owner the right to sell the underlying stock at a specified price by the expiration date. You can kind of think of puts as analogous to selling a stock short.
Okay.
If you believe a stock's price will fall, you can sell shares you don't own, hoping to buy them back lower. Similarly, with a put option, if the price falls, you can exercise your right to sell at the higher strike price, or maybe just sell the put option itself for a profit if its value increased.
And you mentioned protection earlier.
Right. As mentioned earlier, puts can also function as a form of insurance for an existing position. That strategy is called a protective put, and it's designed specifically to shield your holdings from significant declines.
So on one side, we have the buyer or the holder, and on the other, the seller or the writer of the option. Could you clearly delineate their respective rights and obligations within this contract?
Absolutely. The buyer of an option acquires the right, but again, crucially not the obligation, to exercise their option, meaning to either buy or sell the underlying stock at the specified price within the contract's time frame.
They have the choice.
They have the choice. If they choose to act on this right, it's called exercising the option. Conversely, the seller of the option collects the cash premium paid by the buyer upfront. That's their immediate benefit.
But they have an obligation.
Yes. In return, the seller is unequivocally obligated to fulfill the terms of the contract if the option is exercised by the buyer. This means, if they're assigned, the seller must buy or sell the underlying stock at the specified price. It's a legally binding commitment they've made.
Okay, that's a really key distinction. Rights versus obligations. So how does owning an option fundamentally compare to owning actual stock shares? Are they interchangeable?
Oh, they're fundamentally different. Owning an option is really about acquiring choices and rights regarding a potential future transaction. Owning shares, on the other hand, is direct ownership of a piece of a company.
Got it.
With an option, you have the right to perform a certain action, but you're not obligated to do so. You can choose to exercise it, or you can simply let it expire worthless. At that point, its value is gone, the contract is void.
And the size. Options relate to shares in a specific way.
Yes, that's important. Each standard option contract represents 100 shares of the underlying stock.
Yeah.
So if you're buying one call option, you're acquiring the right to control 100 shares.
Okay, so we've laid the groundwork for what options are. Now let's talk about the actual language of covered calls, the key terms you'll encounter and need to understand when you start implementing this strategy. Let's begin with premium. What exactly is it in this context?
The premium is Simply the price of an option contract. It's the amount of cash paid by the option buyer to the option seller for the rights conveyed by that option contract.
It's like a fee for the right.
Exactly. For example, if you write a call option on, say, Microsoft stock and receive $100 from the buyer, that $100 is your premium. The significant point for the seller, the covered call writer, is that this premium is kept regardless of whether the option is exercised or expires worthless.
So it's immediate income.
It's immediate, non-refundable income, yours to keep.
Okay. And the expiration date. That sounds fairly self-explanatory, but is there any nuance there we should know about?
The expiration date is indeed the final date until which an option can be exercised. After this date, the option contract just becomes null and void. It expires worthless if it hasn't been exercised.
Right.
The nuance, I'd say, is that the timing of this expiration, whether it's weeks, months, or longer, dramatically influences the premium received and the strategic implications of your trade. Shorter expirations often mean higher annualized returns of the premium, but they also require more frequent management, more decisions.
Makes sense. Now, the strike price seems like a really central component of a covered call. How critical is it?
Oh, the strike price is profoundly critical. It's the predetermined price at which the underlying asset can be bought or sold if the option is exercised. For a call option seller, this is the stated price per share at which you are obligated to sell the underlying security if the option is exercised.
So that's your selling price if the buyer acts.
Exactly. Returning to our Microsoft example, if you write a call with a $300 strike price and Microsoft's share price rises to or above $300, the option buyer may well choose to exercise. You would then be required to sell your stock for $300 per share, even if the market price of Microsoft shares has, say, risen to $310.
So it caps your upside.
It is the absolute ceiling on your upside for those shares covered by the call.
Okay. So if the market price is higher than the strike price, the option is considered in the money. Could you elaborate on in the money and maybe contrast it with out of the money, which I know we'll discuss later?
Yes, an option is in the money if it have what's called intrinsic value. For a call option, this simply means that the underlying security's current market price is higher than the option's strike price.
So the buyer would profit by exercising.
Correct. The buyer would profit from exercising such an option because they could buy the stock at the lower strike price and immediately sell it at the higher market price, pocketing the difference, minus what they paid for the option, of course. Conversely, an out-of-the-money option has no intrinsic value because the stock price is below the call option's strike price.
Meaning it's cheaper just to buy the stock on the market.
Exactly.
Yeah.
It makes no sense to exercise the option in that case.
Right. And finally, pulling all these concepts together, what specifically makes a call covered? We touched on it, but let's nail it down.
Okay, covered call writing is a strategy explicitly based on selling options against assets you already own. Your existing ownership of the asset acts as the cover against your obligation to deliver that asset if the option is exercised.
Because you have the shares ready to deliver.
Precisely. While there's certainly a risk of having your underlying asset called away, meaning you sell it at the strike price, the seller is typically content with the price received, especially if they initiated the trade with a specific price target or income goal in mind. But it's really important to remember that the downside hedge provided by a covered call is limited strictly to the amount of the premium collected.
Only the premium protects you.
Only the premium. If your stock drops $5, but you received $1 in premium, your net loss on that position is $4, so it softens the blow, but only by that $1. Beyond that premium amount, your exposure to the underlying stock's decline remains exactly the same as if you just held the stock.
Okay.
So by selling a covered call, you immediately increase your investment income and cash flow, with the trade-off, as we said, that your upside potential is capped at the strike price until that option expires.
That clarifies the bedrock principles really well. Armed with that foundational knowledge, let's pivot a bit to why this strategy is so compelling right now, especially for those worried about retirement savings and, the increasing savings gap we hear about.
Yeah, the increasing savings gap among retirees and those nearing retirement is a really significant concern today. It's largely been exacerbated by persistently low interest rates, which, frankly, make traditional fixed income investments much less attractive for income generation than they used to be.
Right. Yields are low.
Yields are low.
Yeah.
So this environment makes finding additional consistent forms of income increasingly necessary. And an effective covered call strategy, particularly when applied to, say, exchange-traded funds, ETFs, or high-quality dividend-paying stocks, can be instrumental in helping to bridge this gap.
How so?
by generating income through the systematic sale of call options, alongside the potential for continued ownership of the underlying shares if they aren't called away.
So it's about creating an additional income stream on top of whatever a portfolio might already be generating. I recall reading an analogy, something about a lease option in real estate that helps explain the cash flow aspect.
Yeah.
How does that parallel apply here?
It's actually a pretty useful analogy. Think of it this way. With a lease option in real estate, you're generating a passive income stream, the lease payments separate from the property's underlying equity value. You get paid for giving someone the option to buy your property later.
Okay.
In the context of stocks, selling covered calls allows you to generate cash flow on your stock portfolio, much like that lease option, and it's distinct from any dividends you might receive. This capacity to earn money on your stock holdings can provide you with income even if your stock price declines somewhat.
Because you keep the premium.
Because you keep the premium. So it offers a valuable layer of, again, modest loss protection for those shares. It's really a conservative strategy that thrives by allowing you to sell the right for someone to purchase your stock at a price that's higher than its current market value at some point in the future.
That's a clear way to put it. Now, let's really bring this to life with some concrete examples. Let's walk through how these strategies actually play out in different market scenarios. Maybe we can start with that hypothetical PepsiCo example.
Certainly. Let's imagine you purchase 100 shares of PepsiCo. The ticker is PEP at $145 per share. Simultaneously, maybe right after buying, you decide to write a call option contract that's valid for 30 days, and you set the strike price at $150.
Okay, slightly above the purchase price.
Right. For granting the buyer this right, let's say you receive an upfront premium of $1 per share. Since each contract covers 100 shares, that equates to $100 in total cash in your account almost immediately. As the seller, you benefit from this $100 profit right away, and it's yours to keep, no matter what happens next with the stock price.
So walk me through it. What's the best case scenario for income-focused investor if PepsiCo simply doesn't move much in those 30 days? Let's say it stays below that $150 strike.
Okay. In that scenario, if PEP remains under $150 by the expiration date, the option buyer will not exercise their right. Why? Because it makes more sense for them to simply buy the shares directly from the open market at a lower price than $150.
Right.
The option then expires worthless. For you, the seller, this is a clear win. You retain the entire $100 premium as pure profit, and you still own your 100 shares of PepsiCo. If you consistently apply this strategy, writing multiple option contracts over time, you can potentially significantly increase the total return on your investment by collecting these premiums repeatedly.
And that's often the goal for income investors, right? Keep the stock, keep the premium.
That's a very common and highly desired outcome, yes.
Okay, but what if PepsiCo's stock price does rise above the strike price? Say it goes to $153 within that 30-day period. This is where that capped upside we mentioned comes into play, correct?
Yes, precisely. If PepsiCo rises to $153, the option buyer will almost certainly exercise their right to purchase your shares at the agreed-upon strike price of $150 per share. In this instance, your shares are called away at $150.
Meaning you have to sell them.
Meaning you sell them at $150. You don't capture the full upside beyond that $150 price. However, as the old adage goes, you never lose money taking a profit. You still profited from the appreciation of the stock, from your purchase price of $145 up to $150, which is $5 per share. Plus, you keep the initial $100 premium. So your total profit would be $500 from the stock appreciation, 5 by 100 shares, plus that $100 premium totaling $600.
So you missed out on the extra $3 per share from $150 to $153, but you still locked in a pretty respectable return in just 30 days.
Exactly. A $600 return on a $14,500 investment in 30 days is quite significant.
Yeah, it sounds like a great deal for the seller there. But I'm curious, how does this play out for the buyer of that option? What's their motivation, and how do they benefit in a scenario like this where the stock price rises above the strike?
That's an astute question because option contracts are often seen as a zero-sum game between the buyer and seller, but both parties enter with a specific intent, a specific expectation.
Right.
The buyer, in this case, initially spent $100 for that option contract. But with the stock now trading at $153, they can exercise their right to buy your shares at $150, effectively getting a $3 per share discount compared to the market price.
So they have an instant paper gain.
They have an unrealized gain of $3 per share instantly. If they choose to sell those shares immediately on the open market at $153, they make a quick profit of $300, $3 per share times 100 shares. Now, after factoring in the $100 premium they originally paid you,
Their net gain is $200.
their net gain is $200. So this example clearly illustrates that the option contract can be mutually beneficial, though, of course, with distinct risks for both parties. The seller has the capped upside risk, and the buyer has the risk of losing their entire premium if the option isn't exercised or sold before expiration.
Okay, that makes sense. That leads us nicely into another hypothetical example, this one with ABC stock, which I think helps quantify the break-even point and the upside cap more explicitly.
Indeed. Let's consider an investor who owns, say, 15,000 shares of ABC stock, currently trading at $100 per share. This investor believes the stock might appreciate modestly, maybe, but probably not by more than 10% over the short term, let's say the next 9 months.
Okay, moderate expectations.
Moderate expectations. To generate some income, they decide to sell call options with a $110 strike price, expiring in 9 months. For selling these options, let's say they receive a premium of $4 per share.
Right.
Now, this $4 premium immediately establishes a downside break-even price. How? You take the current price, $100, and subtract the premium, $4, giving you $96 per share. This means a $4 drop in the stock price would be entirely offset by the premium collected.
So the premium buys you some protection.
It does. It also establishes an upside cap. This is calculated as the strike price, $110, plus the premium, $4, which equals $114 per share. This $114 represents the maximum profit per share if the stock is called away at $110.
Okay, so what are the potential outcomes at expiration in this ADC stock scenario? Can you lay out the 3 primary scenarios for us?
Sure, there are really 3 primary outcomes to consider. In the first scenario, let's say ADC shares appreciate to $105, but remain below the $110 strike price at expiration.
So the option is out of the money.
Correct. The options expire worthless. The seller keeps the entire $4 premium from the sale of the options. Plus, they've gained $5 per share from the stock's appreciation, $105. This strategy, yielding $9 per share, $4 premium plus $5 appreciation, clearly outperforms simply owning the stock, which would have yielded only $5 per share by a margin of 4%.
Okay, that's outcome 1. What's the second?
In the second outcome, let's say ABC shares fall to $96, which is precisely our calculated break-even price. Again, the options are out of the money and expire worthless. The seller retains the $4 premium.
Which perfectly offsets the stock drop.
Exactly. The $4 premium precisely offsets the $4 drop in the stock price, $196. So this scenario also results in the covered call strategy outperforming sole stock ownership by 4%, because the stock-only investor would simply be down $4 per share, whereas the covered call writer is flat.
Okay. And what if the stock appreciates significantly, say, above the strike price, maybe to $120? This is where that called away scenario becomes a reality, right?
That's the third outcome. If ABC shares appreciate significantly to $120, the options are now quite deep in the money. They will almost certainly be exercised at the $110 strike price, and the stock is called away from the seller's account.
So they sell at $110.
They sell at $110. The seller still participates in the appreciation from $100 up to $110 per share, plus they keep the original $4 premium. However, they forfeit the additional $10 of upside appreciation that occurred between $110 and the market price of $120.
So the max gain was $114 per share.
Right. While the investors still capture some of the upside and the premium, their maximum profit is capped at that calculated $114 per share, $110 strike plus $4 premium.
These examples really highlight that core trade-off, capturing immediate income versus potentially limiting that upside gain. Now, for income-focused investors, how does one actually go about adding covered calls to a traditional portfolio, especially with an eye towards supplementing retirement income?
Well, an effective covered call strategy often involves integrating it with, say, high-quality companies that consistently pay attractive dividends. This allows you to use the covered calls to supplement your existing dividend income.
Stacking the income streams.
Exactly. It provides an excellent way to increase overall income, and this can be particularly beneficial during periods of market volatility or consolidation. By selling a call option on an underlying equity position you already own, you collect income from the premium, and you still participate in any appreciation of the underlying stock, but only up to the strike price.
Creating that dual income stream.
Precisely. It's a powerful combination for income seekers.
So what happens practically if the stock does go above the strike price at expiration? What are the steps or the options available for the investor at that point?
Okay, at expiration, if the underlying stock price is indeed above the strike price, you, as the seller, are obligated to sell your underlying equity position at that strike price. As we've said, this means you forego any additional appreciation in the equity position beyond that strike price.
Right.
However, you also typically have the option, for expiration, to buy back the call you originally sold. This is called closing the position. Doing so could result in either a gain or loss on the option itself, depending on how its price has changed since you sold it.
So you could potentially keep the stock if you buy the call back.
Yes, if you buy the call back, you remove your obligation to sell the stock. But the key concept is that the writer of a covered call essentially sells away potential future upside appreciation in the stock in return for that upfront premium income, which simultaneously provides some level of downside protection.
And if the stock does appreciate significantly above the strike, making it likely to be called away, what are the options for the writer if they want to continue generating income from that stock? I think I've heard the term rolling the call.
Ah, yes, rolling. That's an astute observation and a common technique. If the stock appreciates above the strike price near expiration, the covered call writer has a choice. They can either let the shares be called away, delivering the underlying shares to the option buyer and receiving cash equal to the strike price. Or they can roll the call option. Rolling involves two steps done simultaneously. First, repurchasing the original call option you sold to close out that specific obligation. And second, selling a new call option, typically at a new, higher strike price and/or with a different later expiration date.
Why do that?
This allows the investor to potentially capture more future upside in the stock if it continues to rise, while still generating a new premium from the new option sold. It's a more sophisticated way to manage your position if you're still bullish but want to keep generating income.
Okay. And if the stock just stays below the strike, that sounds like the simplest scenario.
That is definitely the simplest outcome. Conversely, if the stock trades below the strike price at expiration, the option will simply expire worthless. The call writer then retains the entire amount of premium collected from selling the option and they still own the stock. Full stop.
Nice and clean.
Nice and clean. And while covered call strategies might seem complex initially, with all the terminology, strike, premium, expiration, they can actually be written quite quickly, often in just a minute or two through most online brokerage platforms.
So the execution isn't the hard part.
Not usually. You create a covered call when you sell a call option on a stock position that you already own. If you happen to buy the stock position and sell the call simultaneously as one combined trade, that specific action is known as a buy-right strategy.
Got it. So stepping back a bit, who is the ideal investor for employing a covered call strategy? Who truly benefits most from this kind of approach?
Well, a covered call strategy is generally most suitable for an investor who is seeking to generate additional income from an existing equity position they hold.
Okay.
This investor should typically be, let's say, neutral to moderately bullish on the underlying stock in the short term. They shouldn't expect the stock's price to appreciate significantly above the chosen strike price before the option's expiration date.
And mindset matters too.
Yes, it requires a certain mental preparation for the occasional reality of having your stocks called away.
Yeah.
You have to be okay with potentially forfeiting some upside gains if the stock really takes off.
Right. Accepting the trade-off.
Exactly. However, covered calls inherently increase your potential return because you always keep the option premium you received up front. That's guaranteed income. And you continue to receive any dividends paid on the underlying stock, assuming the call holder doesn't exercise the option prematurely, which is relatively rare for dividend-paying stocks unless it's very close to the ex-dividend date. So while covered calls do limit the maximum amount you can make on a significant rise in share prices, because you might have to sell the stock before it reaches its theoretical peak value they consistently add to your income. This makes them an excellent strategy in, say, flat or moderately rising markets, or just generally for investors focused on increasing their consistent rate of return over the long term.
Okay. Now that we have a clearer picture of the mechanics and the target investor, let's look at a specific real-world application, maybe that Verizon example you mentioned earlier, and then we can tackle some of those evolving perspectives on how to best use this strategy.
Sounds good. Let's consider a scenario where you purchase 100 shares of Verizon stock METs. VZ is the ticker for $54 per share. Your total investment there is $5,400, and let's just exclude commissions for simplicity.
Okay.
Now, Verizon currently pays a dividend of $2.56 per share annually. Based on that $54 stock price, that translates to approximately a 4.6% yield. It's important to remember, though, that while the dividend amount, $2.56, generally remains constant unless the board changes it, the yield itself will fluctuate up and down with the stock price.
Right, yield is price dependent.
Exactly. So let's say you're content with a 4.6% dividend return, but you're an income investor and you want a potentially higher rate of return. So you decide to write a covered call on your Verizon shares. You understand the basics? If the stock doesn't reach the strike price, you'll keep the option premium in addition to any dividends paid. If it does hit the strike price, the option holder will likely exercise, but you'll still be paid the strike price for your shares, and you'll also retain that original option premium.
So even if the stock gets called away, you're still making a defined profit. That's really the key comfort for many income investors, isn't it?
It is. It provides a level of predictability.
Now, how do we actually choose the right strike price for this Verizon call, especially if the goal is generating regular income?
Okay, you typically consult an options trading chart or chain for Verizon. Looking at hypothetical prices for, say, 30-day expiration call options, you might see various strike prices available. You might see strikes as low as $50, even with the stock trading up at $54.
Those are in the money.
Those are in-the-money auctions, yes. And if you were to sell them, they could potentially be exercised almost immediately because they already have intrinsic value. You typically only consider selling such deep-in-the-money calls if you were maybe short-term bearish on the stock, or perhaps tactically looking to exit your position anyway due to that high probability of immediate exercise.
Okay, so probably not the first choice for regular income generation if you want to keep the stock.
Generally not, no.
What if we were looking for more of that regular income stream without necessarily expecting a big dramatic move in the stock price? Either way.
In that case, you would typically look at out-of-the-money options. So sticking with Verizon at $54, an option giving someone the right to purchase the stock at a $56 strike price, that's $2 above the current price, might cost the buyer, say, $1.15 per share. That translates to $15 for the 100-share contract.
$15 doesn't sound like a lot.
Well, $15 might not seem like a substantial sum on its own, but the annualized rate of return it represents can be quite attractive. Think about it. If this option is not exercised in the next month, you keep the $15. If you could consistently execute this exact type of trade 12 times in a year without the stock being called away.
Which might be optimistic.
It might be, but for illustration, your annualized rate of return from just the premiums alone would be approximately 3.3%. $15 by 12 months equals $180, divided by the $5,400 initial investment. Now, when you combine this 3.3% premium yield with the existing 4.6% dividend yield,
You're looking at almost 8%.
your total combined annual rate of return from cash flow would be 7.9%. And importantly, this is achieved without incurring additional stock risk beyond giving up the potential for upside appreciation above that 56 stock price.
But crucially, there's always the inherent risk of the underlying stock itself, right? What if Verizon declines significantly, maybe more than the $1.15's premium collected?
Absolutely. That's a critical point. There is always inherent risk with any stock investment. Covered calls only hedge the downside to the extent of the premium guaranteed. That's it.
So the buffer is limited.
Very limited. If Verizon were to decline substantially in value, say it drops $5 per share, the $1.15 premium would only offer very partial protection against that loss. You'd still be facing a net loss of $4.85 per share on that position.
Okay. And conversely, what if Verizon were to make an extraordinary jump? Say it goes to $70 per share and you wrote that $56 call. You're contractually obligated to sell at $56. That might not feel like a win at that moment, even though technically you profited.
Right. The psychology is interesting there. It might feel like you lost that potential gain from $56 to $70. However, even in that scenario, if the option is exercised at $56, you would still profit from the move from your $54 purchase price up to the $56 strike price, $2 per share. Plus, you would have kept the original 86-tot option premium.
So it's still a positive outcome on the trade itself.
Absolutely. Which is why it's often described, perhaps a bit optimistically, as a win-win-win scenario. You receive the covered call premium, win one. You receive the dividend yield while you held the stock, win two. And you potentially profit from the higher share price up to the strike, win three.
Okay. That brings us to a really interesting point about the actual philosophy behind using covered calls. I've heard some, let's say, challenging perspectives recently on whether they are always the answer or if they should really be applied to every position you hold. Can you elaborate on this kind of evolving viewpoint among experienced traders?
Yes, this is a critical distinction in, I'd say, modern options trading, and it does challenge some long-held beliefs. The traditional old-time covered call writers, if you will, often prioritize maximizing premium generation above almost everything else.
Just get the income.
Just get the income. They might advocate for writing covered calls on virtually every eligible position you hold, maybe even insisting on owning only round lots, blocks of exactly 100 shares to facilitate this. They might view odd lots, for example, having 162 shares where you could only write one call on the 100 shares, leaving 62 uncovered, as somehow wasted because you couldn't write a call on those specific 62 shares.
So a very rigid focus on maximizing premium per share owned.
Almost exclusively, yes. Their focus was primarily on consistent premium capture.
And what's the counter perspective to that traditional, maybe more rigid view? It sounds like there's a push for a more nuanced approach now.
The alternative, and I think increasingly dominant philosophy today, is that risk-adjusted total return is paramount. It doesn't really matter whether that return comes from dividends, covered call premiums, or pure market appreciation of the stock. The source of the profit is less important than the overall growth of your capital and income, adjusted for the risk taken.
So looking at the whole picture.
Exactly. And regarding those odd lots, the modern view is quite different. They're not seen as a waste at all. In fact, owning an odd lot could potentially improve your total return over time. Why? Because if the stock experiences a significant upward surge, your entire position isn't called away at the strike price.
Ah, so the uncovered shares still capture the full upside.
Precisely. You still benefit from the full appreciation of those uncalled shares, allowing you to capture more of the dramatic upside that would otherwise be completely capped if you only held round lots and covered them all. This concept might be counterintuitive to those steeped in the traditional methods, but it prioritizes overall portfolio return over strict adherence to premium maximization on every single share.
So it's about total wealth accumulation, not just optimizing individual option contracts in isolation.
Well put. It's about the total wealth impact.
So this implies being more flexible and tactical rather than just systematic in every single situation. Almost like not playing every hand in poker just because you have chips.
Exactly the right analogy. The assumption that covered call writing is the ideal solution every day, in every environment, and in every single market is really strongly challenged by this tactical approach. As the poker saying goes, you don't put all your chips in on every hand, you look at your cards and you think about it.
Right.
Covered call writing should be approached similarly. Use them when it genuinely makes sense strategically, considering the current market landscape, the stock's specific situation, and maybe volatility levels. It never makes sense, as they say, to cross a busy highway to pick up a proverbial nickel if the risk of getting hit by a market crash outweighs the small potential reward of the premium.
So it's about harvesting volatility when it's appropriate, maybe when premiums are high, and knowing when to perhaps just hold the stock and let it run.
Yes, precisely. A tactical approach allows investors to harvest volatility, meaning collect higher premiums when conditions are favorable, maybe during uncertain or sideways markets, and then crucially, to dial back or stay out of the way entirely when markets are performing strongly and, rising tides are lifting all ships.
Because systematic writing caps that upside in a bull run.
Exactly. While systematic covered call writing might underperform in strong bull markets due to that capped upside, a tactical approach allows for greater participation in that upside when it occurs, while still leveraging the income-generating and risk-reducing benefits when they are most needed, perhaps during corrections or consolidations. The concluding thought on this perspective is quite clear, I think. Covered calls work best when you need them the most.
Work best when you need them the most.
That makes a lot of sense. It's during those periods of uncertainty, or maybe just sideways chop, that they really shine.
That's typically when they add the most value relative to just holding the stock. Okay. Now, to put some actual data behind this concept, I understand the Chicago Board Options Exchange, the CBOE, introduced an index that specifically tracks a covered call strategy. This gives us a kind of benchmark for performance, correct?
That's correct. Back in 2002, the CBOE introduced the CBOE S&P 500 Buy Right Index, which is known by its ticker symbol BXM. This index was specifically designed as a benchmark to track the hypothetical performance of a very mechanical covered call strategy.
How does it work? What's the mechanism?
Its design is quite straightforward. It simulates an investment strategy that notionally buys the S&P 500 index portfolio and simultaneously sells the nearest one-month at-the-money call option against that underlying index position,
So always selling at the money call.
or slightly out of the money, typically. At each option expiration date, which is usually the third Friday of the month, the strategy notionally sells a new one-month at or slightly out of the money call option. It's a very consistent, rules-based approach designed to be easily replicable.
And how has this BXM index actually performed since its launch, particularly when you look at risk and return compared to just holding the broader S&P 500?
Well, since its inception, the BXM index strategy has demonstrated some pretty impressive results, particularly in terms of risk mitigation and volatility reduction when compared directly to the S&P 500 index itself.
Less bumpy ride.
Significantly less bumpy. It has historically provided excess relative returns during bear markets or flat periods, and importantly, with roughly one-third less volatility than the underlying S&P 500.
Wow, one-third less volatility is substantial.
It is. These favorable results are primarily attributed to the benchmark's conservative strategy of systematically selling those at or slightly out of the money index options on 100% of the underlying equity index value. It really underscores that for the investor focused on steadier compounding and maybe less heartburn during market swings, well, sacrificing some of that dramatic bull market upside can be a perfectly rational and often, over the long run, a superior trade-off.
It's that slow and steady wins the race idea again, even in a volatile market.
Exactly, especially if it helps you stay invested through the downturns.
Yeah, good point. This sounds like a potentially powerful tool for overall portfolio management. How does including a covered call asset class, maybe through an ETF that tracks something like BXM, fit into broader portfolio diversification and income generation, especially in today's market environment?
Including a covered call asset class can significantly diversify both the equity and the fixed income allocations within a traditional balanced portfolio.
How so?
While given its inherently lower volatility profile, as clearly demonstrated by the BXM index history, a covered call strategy can also potentially afford a balanced investor a greater risk budget to allocate into other equity investments, maybe more growth-oriented ones.
Because the covered call part is less volatile, it frees up risk capacity elsewhere.
Potentially, yes. The strategic allocation can enhance the potential risk-adjusted return for the entire portfolio, with potentially only modest adjustments to the overall risk profile. It's really a way to refine your portfolio's overall risk-return characteristics.
And what about the current income benefit? How significant is that dual stream of income we talked about, dividends plus premiums?
The current income benefit is definitely a key advantage, and it's particularly attractive for income-focused retail investors, especially those nearing or in retirement. Investors potentially earn not only the stock dividends from their underlying holdings, but also capture the premium income from the sale of the call options.
That stacking effect again.
That stacking effect. This dual income stream further enhances the cash flow component of the underlying investment. This is particularly attractive when you're utilizing more stable, maybe larger capitalization equities that already pay attractive dividends, as the total cash flow can be substantially enhanced by consistently collecting that call premium income, providing a potentially more robust, predictable stream.
And does it play any role in managing interest rate risk? That's obviously a big concern for many fixed income investors right now.
Yes, it certainly can play a role there. Income-oriented investors can potentially help diversify against the interest rate risk, typically associated with traditional fixed income investments, through the strategic use of a covered call strategy.
How does that work?
Well, while fixed income investments are generally inversely correlated to interest rates, meaning their value often declines when rates rise, covered call writers can actually sometimes benefit in rising rate environments. This is partly because the value of call premiums tends not to be as significantly negatively affected by rising interest rate levels as bond prices are.
So less sensitive to rate hikes than bonds.
Generally speaking, yes. Of course, by opting for covered calls, investors are consciously choosing to accept equity market risk, the risk of the stock price falling over the duration risk or price risk inherent in fixed income investments. But it does offer a valuable diversification tool in that regard, shifting the type of risk you're exposed to.
Okay, that's a really comprehensive look at the overall benefits and the portfolio context. Now let's dive into the specific strategic choices investors face when they're actually writing covered calls. Specifically, that difference between selling in the money, at the money, and out of the money options. How do these choices tailor the strategy to different outlooks or goals?
Right, the decision to write an in the money ITM, at the money ATM, or out of the money OTM call, fundamentally depends on your specific investment goals and your current market outlook for the underlying asset you own.
So no single right answer.
Definitely not. The initial step is always, or should be, to select assets that you're genuinely willing to sell for the right price. If you're not willing to part with the stock, maybe don't write calls on it.
Good point.
Then you assess what you believe the asset is likely to do in the short term, go up, down, stay flat. That assessment will guide your strike price selection. It's really a dynamic choice based on your conviction and your objective for that specific trade.
Okay. So let's say an investor is maybe a bit concerned about a stock decreasing in value in the near term. Perhaps they want to lock in a price or get more downside protection. Would an in-the-money call be their likely choice?
Precisely. An in-the-money call is characterized by having a strike price that is lower than the current market value of the underlying asset.
Okay.
The premium you receive for selling such an option will typically be quite high, largely due to the high probability that the option will be exercised because it already has intrinsic value.
Makes sense.
For example, returning to our Verizon scenario, when the stock was at $54, a call option with, say, a $52.50 strike price might sell for $1.75 per share premium. That's an in-the-money option. The higher premium, $1.75, helps to offset a potential drop in the stock more significantly. In this case, the $52.50 strike plus the $1.75 premium provides a buffer effectively down to $50.75. By all $1.75, $1.50 equals $50.75 intrinsic value. 54 turnover, $50.75 equals $3.25 protection. Wait, let me rephrase that. The effective sale price, if exercised, is $52.50 plus $1.75 equals $54.25. So it protects down to $52.50, but guarantees a higher effective sale price.
So it offers more downside protection via the higher premium.
Yes, it offers more downside protection, but the trade-off is that it's also very likely that the option will be exercised, maybe even before expiration. So you absolutely must be willing to let the stock go at that strike price plus premium. If not, this strategy is probably unsuitable for that particular holding you want to keep long-term.
Okay. What if the expectation is simpler that the shares will remain relatively flat, just range bound? Is there a sweet spot for generating extra income without taking on too much risk of the stock being called away or giving up too much potential upside?
If you anticipate that the shares will likely stay flat, you might aim to generate extra income by writing an at-the-money call. This type of call has a strike price that is very close to the current market price of the underlying asset,
Right at the current price, basically.
or very near it. It will typically yield a moderate option premium, higher than OTM but lower than ITM, and it can effectively increase your overall return in a sideways or range-bound market. However, if the price of the shares does begin to rise even slightly, the option will likely move into the money and might be exercised, causing you to miss out on any future upside appreciation beyond that strike price.
So good for sideways markets, but sensitive to upward moves.
Exactly. It's a common choice for investors seeking steady income in what they perceive to be a range-bound market environment.
And what's the strategy if you expect the shares to rise, but maybe only by a small amount, and you actually want to participate in some of that appreciation while still collecting a bit of premium on the side?
In that case, you would typically write an out-of-the-money call. This is where the strike price is set higher than the current market value of the underlying asset.
Giving the stock room to run up?
Exactly. Now, while you will receive a relatively lower premium for this type of option compared to an in-the-money or at-the-money call, you also retain more of the potential appreciation in the asset's value, specifically all the appreciation up to the higher strike price.
Can you give an example?
Sure. Using the Verizon example again, stock at $54. If you write a 50-day covered call with, say, a $57.50 strike price, which is $3.50 above the current price, you might only receive a $0.10 premium, $10 per contract. It's small. But if the stock does rise to $57.50 by expiration, you would profit by $3.50 per share from the stock's appreciation, $57.50 in premium, plus the $1.10 premium, for a total gain of $3.60 per share.
So the lower premium is offset by capturing more stock appreciation.
Correct. It's a more balanced approach for someone who is slightly bullish but wants to enhance their return with some premium income.
Okay, so the key takeaway here seems to be really tailoring the strike price, ITM, ATM, OTM to your specific outlook for the stock and your primary investment goal, whether it's maximizing protection, maximizing current income, or allowing for some upside participation. It's definitely not a one-size-fits-all decision.
Absolutely not. The fundamental decision really hinges on what you believe will happen to the value of the underlying asset in the time frame of the option, and how that aligns with your specific investment goals for that particular holding.
Right.
If your primary objective is, say, to earn a little extra money on an asset you hope to hold on to for the long term, the ideal scenario is often for the stock price to get very close to the strike price without actually exceeding it at expiration.
So the option expires worthless.
Exactly. That way, you keep the full option premium and you enjoy the gain in the stock's value up to that point. However, if your goal is different, maybe to maximize a guaranteed rate of return over a specific period,
Like if you're planning to sell anyway?
perhaps, then you would choose a strike price and expiration date combination that offers the greatest calculated return, stock appreciation to strike plus premium, fully accepting, even hoping that if the option is exercised, the stock will be called away. You would have achieved your desired return regardless of what the stock did afterwards.
Okay, that makes the strategic thinking clearer. Let's try to illustrate this income maximization potential with another example. I think you had one involving Marathon Petroleum, MPC. Let's see how those numbers can really add up.
Certainly. Let's imagine an investor owns 1,000 shares of Marathon Petroleum, ticker MPC. Let's say the stock is currently trading at $65 per share. MPC also pays a dividend. Let's assume it's $2.32 per share annually, which translates to about a 3.5% yield at that price.
Okay, so baseline income is $2,320 a year from dividends.
Right, $2,320 in dividends each year just from holding those 1,000 shares, $2.32 by $1,000. Now, the investor wants to try and increase their risk-adjusted rate of return, so they decide to write covered calls on these shares. Looking at the available call option prices with, say, a 3-month expiration, they identify an opportunity. They could sell options with a $70 strike price that's $5 above the current $65 price for a premium of $2.40 per share.
$2.40 per share times 1,000 shares.
That amounts to $2,400 in total premium, $2.45 per 1,000 shares, assuming 10 contracts. And that $2,400 is immediate cash deposited into their account.
Nice. So what are the potential outcomes with this Marathon Petroleum strategy over that 3-month period? Walk us through the income generation aspects if the stock doesn't hit the $70 strike, and then what happens if it does.
Okay, scenario 1. If a stock does not hit the $70 strike price within those 3 months, the options expire worthless. The investor's earnings for that quarter would be the $2,400 premium they collected, plus any dividends received during that period, maybe one quarterly payment.
And if they could repeat that.
All right, let's extrapolate. If they were hypothetically able to consistently receive a similar option premium without the stock being called away, and repeat this process 4 times over a 12-month period, well, their total return from just selling the covered calls would be approximately $9,600, $2,400 by 4,
Plus the dividends.
plus the $2,320 in annual dividends. Their total annual cash flow would add up to $11,920. Now, on an initial investment of $65,000, 1,000 shares at $65, that represents a pretty impressive 18.3% annual cash flow return.
Wow, that's substantially higher than the dividend alone.
Much higher. That's the power of adding the premium income.
Okay, but what if the stock does hit the strike price of $70, meaning it gets called away? What's the silver lining there for the income investor? And maybe how do you reframe that missed upside if MPC keeps running higher after that?
Right, scenario 2. If the stock does hit or exceed the strike price of $70 per share by expiration, it's very likely to be called away. In this scenario, the investor would still participate in the $5 per share appreciation from their original assumed purchase price of $65 up to the $70 strike. That adds another 7.1% return. $5 gain, $70 strike, $5 gain, $65 cost basis is 7.7% appreciation.
Plus the premium.
Plus, they keep the $2.40 premium per share. So the total gain per share is $5 plus $2.40 equals $7.40. While they would then need to find another stock to buy to continue generating income, or perhaps even repurchase MPC shares, maybe at a higher price, to restart the covered call cycle, it's really important to remember 2 critical points here.
Okay.
First, you will never lose money simply from the act of writing covered calls. Once the call is written, you receive the premium, and it is yours to keep, period. Whether the stock goes up, down, or sideways doesn't change that. Any loss you might incur on the overall position would be from a decline in the underlying asset's value itself.
Which the call premium can only modestly offset.
Exactly. It acts as a buffer, but only up to the amount of the premium received.
Okay, that's point one. What's the second point about reframing that perception of missing out on potential profits if the stock really skyrockets? That can be a hard pill to swallow for some investors.
Right, the psychological aspect. Look, it's kind of like complaining you only found $50 in an old coat pocket when your friend happened to find $100 in theirs. You still found $50.
Uh-huh. Good analogy.
The focus really shouldn't be solely on the theoretical missed upside, but on the consistent, tangible profit you did secure with defined risk. For instance, let's take another quick example. If you bought CSX stock at $32 and wrote a covered call with a $35 strike, maybe collecting a $1.50 premium, then CSX unexpectedly skyrockets to $38 before expiration.
Okay.
The option will most likely be exercised, forcing you to sell your shares at $35. You would profit $3 per share from the stock appreciation, $35 or $32, plus you keep the $1.50 option premium for a total gain of $3.50 per share.
Which is a good return.
It's a very good return. The odds of a stable stock like CSX jumping almost 19% from $32 to $38 in a short period, say 30 days, are generally not very high. And even if it does happen, making that $3.50 per share profit on a $32 investment means you could have made almost 11%, $3.50, $32 in just 30 days.
It annualizes incredibly well.
Right. On an annualized basis, assuming you could magically execute that exact trade repeatedly, your rate of return could theoretically total over 130%. So rather than regretting the theoretical loss of the additional $3 profit from $35 to $38, the focus should probably be on happily pocketing that kind of solid defined return and then moving on to identify another potentially profitable covered call investment opportunity.
And this highlights why maybe diversification is crucial, especially if you're doing this with individual stocks.
Absolutely critical. That example underscores the risk of being concentrated in one stock that takes off unexpectedly. For average investors, especially those with smaller amounts to invest, writing covered calls on broad market or sector exchange-traded funds, ETFs, offers inherent diversification and helps minimize that specific stock risk while still allowing you to generate premium income.
Okay. This strategy certainly seems to have many potential benefits for income investors. Let's try to summarize the key advantages that make covered calls such a compelling tool for them.
Sure. The benefits are, I think, quite compelling for income-focused investors. First and foremost, covered calls have the potential to generate a steady stream of additional income, especially in flat to moderately rising markets.
Because you always keep the premium.
Because you always keep the premiums received up front from selling the option, regardless of subsequent market changes in the underlying stock price. This means you potentially collect both dividend distributions from the underlying stock and the premium income from the call option, creating that powerful dual income stream we talked about.
And the income itself is almost immediate, right? Which gives a quick boost to liquidity or cash flow.
Yes, that's a significant practical point. When you write a covered call, the premium is typically credited to your brokerage account within a day or so, sometimes even faster. It becomes immediately available cash for reinvestment or for use as, say, monthly cash flow if you're in retirement. Since there's no obligation to pay the premium back, you have full discretion over its use from day one.
The predictability of returns also seems like a major advantage, especially for those maybe in retirement seeking more stability.
It is indeed. With covered calls, unlike just holding stock, you can calculate and know the initial outcome and the maximum potential rate of return you can expect at the time you write the call. This provides a predictable element to your investment strategy that is often missing from pure equity investing.
In risk reduction.
Yes, they help reduce risk modestly. If the value of your ETF or stock falls, the premium you receive from writing the covered call helps buffer the total loss in your investment, softening the blow. And of course, you retain all dividend distributions until the ETF or stock is actually called away, if it ever is.
And how convenient are they to actually trade? Is this something accessible to most retail investors these days?
Oh, very accessible. Covered calls are traded on open exchanges, just like individual stocks or ETFs. You can buy and sell options through most online brokers or manage your own trades online. It's quite accessible for investors with the appropriate brokerage account approval level, which usually isn't too hard to get for covered call writing.
Okay.
Their application to ETFs, as we mentioned, offers inherent portfolio diversification because ETFs cover virtually all major stock indices and asset classes, reducing that specific stock risk. The upfront premium acts as that form of downside protection, partially offsetting price declines. And until the stock is called away, you also maintain all the benefits of stock ownership, including receiving dividends and having voting rights.
And volatility reduction.
And finally, yes, for equity investors overall, covered calls contribute to portfolio volatility reduction, providing potentially greater return consistency, which really aligns back to that initial quest for certainty we started with.
Okay, with all those clear benefits, it's absolutely essential that we also understand the risks and the important considerations involved with covered calls. What should investors be acutely aware of before diving in?
Right, no free lunch.
Yeah.
It's crucial to understand that covered calls require an underlying investment in stocks or ETFs. That means your capital is still subject to market dips and overall equity risk.
The premium isn't a magic shield.
Not at all. While the premiums offer some protection, it's only partial, often modest. If the market experiences a severe downturn, the value of your underlying investment will likely decrease substantially, and the premium collected may not come close to fully offsetting those losses. You still own the stock risk.
And the most commonly cited risk.
The most frequently cited risk, or trade-off, is the limited upside gains. If the value of your underlying asset substantially exceeds the strike price by expiration, the option will likely be exercised, and your shares will be sold at that lower strike price, causing you to miss out on further appreciation above that level.
The opportunity cost.
Exactly. While this is the explicit trade-off for getting the upfront premium and the predictability in very strong bull markets, you might find you would have been better off simply holding the stock and not selling the calls.
Okay. And can options be exercised literally at any time, or only right at expiration? That seems like an important nuance for planning.
That's a good question. While options are most commonly exercised at or very near their expiration date, especially for call options on non-dividend or low-dividend stocks, the holder of an American-style option, which includes most individual stock options in the U.S., technically has the right to exercise their contract at any time up to and including the expiration date.
So your shares could be called away early.
It's possible, though less common if the option doesn't have much time value left or if there's an upcoming dividend. If this occurs, however, you're immediately paid the strike price for those shares in cash, providing capital that can be reinvested elsewhere to continue seeking returns. So it's not necessarily a bad outcome, just maybe unexpected timing.
What about liquidity? Are all options easy to trade?
Another consideration is potentially thin trading or low liquidity for some options. Options on very popular stocks or ETFs are usually very liquid, with tight bid-ask spreads. But options on less commonly traded stocks might be less widely traded.
Meaning a bigger gap between buy and sell prices.
Exactly. A larger bid-ask spread, which means there might be a wider gap between what a buyer is willing to pay, the bid, and what a seller wants to receive, the ask. This can eat into your profits, especially on lower-priced options. This can usually be mitigated, though, by using limit orders when you sell your calls, where you specify the exact minimum price you're willing to accept for the premium.
Okay, always use limit orders. Good tip. What about the premium amounts themselves? Do they stay consistent over time, or do they fluctuate with market conditions?
Oh, premium amounts are definitely not constant. They vary significantly with market conditions, primarily driven by implied volatility.
Volatility is key.
Volatility is key. Premiums tend to be higher in more volatile markets due to increased uncertainty and higher demand for options, both calls and puts. They tend to be lower in very stable, quiet markets where perceived predictability is greater. So while the premium amount you receive for a specific contract is locked in and guaranteed once you've sold it, the amounts you might receive for subsequent contracts you write on the same underlying asset, even at the same strike, may fluctuate quite a bit month to month or week to week.
And finally, costs.
And lastly, like all trading, commissions are a factor to consider. You will likely incur commissions to your executing firm or broker for each options trade, both selling to open and potentially buying to close. And these rates can vary widely between brokerages. It's important to find a brokerage that aligns with your trading style and offers reasonable commission rates, as high commissions can significantly eat into the profitability of strategies involving smaller premiums. Many brokers offer zero commission on stocks now, but options often still have a per-contract fee.
Right, you need to factor those in. Okay, given all these benefits and these risks, where do covered calls fit in strategically, especially when we think about qualified accounts like IRAs and 401ks, where tax implications are such a major consideration for long-term growth?
Qualified accounts. Covered call strategies can potentially make a really profound difference when implemented within qualified accounts. Think traditional IRAs, Roth IRAs, rollover 401ks basically, accounts that contain an individual's core life savings and retirement funds.
Why the big difference there?
The significant advantage is the tax treatment. In qualified retirement accounts, generally speaking, there are no immediate taxes due on the option premiums you collect, nor on the dividends you receive, nor on any capital gains realized from stocks being called away or bought and sold within the account.
Everything grows tax-deferred or tax-free.
Exactly. All your gains, your dividends, and your option premiums compile and compound on a tax-deferred basis in traditional accounts, or a potentially tax-free basis in Roth accounts. This allows your money to potentially grow much faster over the long term without being eroded by annual taxation along the way. That tax deferral or elimination can dramatically enhance the power of compounding over decades.
And how does that contrast then with doing this in a regular, non-qualified or taxable brokerage account, where capital gains taxes can often heavily influence investment decisions?
It's a huge difference. In non-qualified taxable accounts, positions with a large embedded capital gain, meaning a low-cost basis, are often held for extended periods, sometimes indefinitely, simply to avoid triggering immediate tax recognition upon sale. This tax lock-in effect can sometimes trap investors in suboptimal holdings or prevent them from rebalancing effectively.
Right. Taxes dictate strategy.
Taxes can limit an investor's flexibility in managing their portfolio dynamically, as almost every transaction has a potential immediate tax consequence that needs to be considered. However, within qualified accounts employing a covered call strategy, you generally have significantly greater flexibility and choices because that tax recognition is deferred until you actually withdraw funds in retirement, or potentially never with a Roth.
So more freedom to manage actively.
Much more freedom. This can free up capital from called-away stocks for reinvestment without immediate tax bite and allow for more dynamic portfolio management overall, without the constant worry of optimizing around short-term versus long-term capital gains taxes.
Okay. So thinking about suitability, who is the strategy really most appropriate for, perhaps in terms of investment size? And are there different approaches recommended for different account sizes?
Well, in my opinion, based on managing costs and diversification, any individual with, say, $250,000 or more to invest is probably well positioned to write covered calls effectively on a diversified portfolio of individual dividend-paying stocks.
And for smaller amounts?
For smaller investment amounts, it might make more practical sense to use ETFs for diversification. Writing calls on ETFs allows you to gain broad market or sector exposure without needing the capital to purchase 100 shares of numerous individual, potentially expensive stocks like, say, Amazon or Google. It makes the strategy accessible with less capital.
And people can use their existing retirement accounts.
Absolutely. Furthermore, individuals can often roll over their individual retirement accounts, like old 401k plans from former employers, into an IRA where they can implement strategies like covered calls to potentially diversify their portfolios and income streams beyond just stocks and bonds.
And the potential impact over time.
This strategy, applied consistently and thoughtfully over time, can potentially make a tremendous difference in growing account value and generating income, especially for accounts ranging from, say, $500,000 to $1 million or more, by consistently generating that extra income and helping to manage volatility along the way. It's also certainly suitable for institutional investors like trusts, endowments, and even larger organizations managing 401k plan assets, although the implementation might differ.
Okay. And a final but really crucial piece of advice for anyone listening who's considering implementing this strategy. It sounds like there are definitely many nuances to consider carefully.
Crucially, yes. Before engaging in any new investment strategy, and this definitely includes covered call writing, it is absolutely essential to consult with your own trusted tax advisor, your accountant, and your financial planning professional.
Get personalized advice.
Get personalized advice. They can help you understand the precise personal implications, tailored specifically to your unique financial situation, your risk tolerance, and your long-term goals. They can ensure you fully understand every aspect of what you're getting into, including the tax consequences in your specific situation and how it fits sensibly into your broader financial plan and overall risk tolerance. This professional guidance is truly invaluable and shouldn't be skipped.
Excellent advice. We have covered a tremendous amount of ground today on covered calls, from their fundamental definitions and mechanics to tactical applications, real-world examples, benchmarks, and the important nuances of various outcomes and risks. This has truly been a deep dive.
It has.
Yeah.
And to maybe recap the core idea, covered calls offer a robust method for potentially generating additional income, reducing portfolio volatility somewhat, and providing a degree of downside protection in an investment portfolio.
Mm,
The key takeaway, as we've emphasized, particularly from the tactical perspective, is that covered calls often work best when you feel you need them the most during uncertain or sideways markets. They limit your risk primarily by capping your potential upside on a significant bullish move in the stock, while consistently generating potentially solid returns across various other market conditions. It's really about trying to convert market chop or volatility into an income opportunity.
So, for you, our listener, the question to ponder is how this strategy might align with your own personal financial goals, especially if consistent income generation and proactive risk management are high priorities in your portfolio construction. How might a tactical, thoughtful application of covered calls reshape your approach to generating consistent income and managing risk in what often feels like an unpredictable market? Could it help you potentially turn that very volatility into a powerful source of opportunity over time?
And remember, this deep dive into the world of covered calls was brought to you by Finbot Insights.
That's right. If you found this information valuable and maybe illuminating, please make sure to click that like button below and perhaps share it with someone else who might benefit from understanding this strategy better. And for more deep dives into complex financial topics like this, ensuring you stay well informed and ahead of the curve. Well, don't forget to subscribe to our channel. We're always uncovering surprising facts and hopefully just enough humor to keep you hooked. Thanks for joining us.